The working capital management. Let's say this. We'll just summarize. Then we'll highlight some key areas where you need to revisit. So you just summarize them as much as we can. Key items of those notes. Some application in terms of computation. Then we'll highlight some of the areas that we saw. We have some emphasis. So we say that it is the management of current assets. It is the management of current assets and current liabilities. It is the management of current assets and current liabilities, i.e. inventory, debtors, cash, and payables. Inventory, debtors to receivables, cash, and payables. Next, you say gross working capital. Gross working capital is the total of current assets. Gross working capital is the total of current assets. While net working capital is the difference between current assets and current liabilities. Well, net working capital is the difference between current assets and current liabilities. So you need to, as you go through the notes, have an idea on factors that influence, just put it down, factors that influence working capital needs of a firm. Factors that influence working capital needs of a firm. So that one is to read the pitia warning. Then you also take note of objectives of working capital management. Objectives of working capital management. Ziko tu mbili. There are two key objectives: to maximize the returns, to minimize the risk. So also take note of that, have a read of it. So that you can write for me permanent, the small subtopic again, permanent and seasonal. Permanent and seasonal stroke variable working capital. Permanent and seasonal stroke variable working capital. So it is always said that there are some current assets that are also considered to be fixed. Eti kuna current assets ambazo ni fixed assets. Does it make some sense? That is kuna stock ambayo ni fixed asset. Is it possible? It doesn't even add up, right? The stock ni current asset tumejua. But in finance, let me ask this way, maybe to make us understand. If you deal with stock, is there any time in the business you'll operate with zero stock? Okay, operate with zero stock, that means you're not in business. So tunasema kuwa, there is always that minimum level of stock that a firm must maintain at all times to meet its normal demand. Kuna ile level yenye stock ikifika, everybody who is involved gets scared. Sindio? Na natafuta vile ata order stock because you're likely to run out of stock. So there is a minimum level of current assets that a farm must maintain at all times to be able to meet its normal demand. That minimum level is fixed. And that minimum level is what we call the permanent working capital or the permanent current assets. Anything above that will now fluctuate to meet some extra demand. Like I always like giving examples of something like, let me talk about umbrellas. Umbrellas in Nairobi are very notorious. Tunafunikanga nywele zetu wakati mvua imekuja, ndio. Saa hizi tunaangalia kwa street hakuna mtu anakuta umbrella. Lakini mvua ikianza kunyesha saa hizi, women don't know where they come from, right? So there's a stock that is somewhere to take care of that additional demand that arises due to peak. So that extra demand will always fluctuate. Sasa inaenda na demand sasa. So let's say this. So we say there is always a minimum level of current assets. There is always a minimum level of current assets. From working capital, there is always a minimum level of current assets from working capital maintained by the farm. Maintained by the farm at all times, so as to meet the normal demand. So as to meet the normal demand. Full stop. This level is known as permanent stroke fixed working capital. This level is known as permanent stroke fixed working capital. The next point. Any extra amount of working capital, will fluctuate. Any extra amount of working capital will fluctuate so as to meet the additional demand. So as to meet the additional demand during peak periods. And it is known as fluctuating, stroke seasonal, stroke variable working capital. It is known as fluctuating stroke seasonal, stroke variable working capital. Then another subtopic, working capital, financing policies. Stroke approaches. Working capital financing policies, stroke approaches. Let me say, when financing its assets, the farm can use any of the three approaches. The farm can use any of the three approaches depending on the management's risk attitude. So we have three policies that can be applied by the farm. depending na what is the risk appetite of the management. I.e., number one, we have aggressive policy. So aggressive policy, you say, it is adopted by risk takers. It is adopted by risk takers who uses short-term funds. To finance most of their assets. Finance most of the firm's assets. Who uses short-term funds to finance most of the firm's assets. So the risk. Short-term funds are highly risky, and that's why we are risk takers. We don't mind going for the financing that is highly risky to finance the better part of our assets. So if I'm a risk taker, sitaendea loan ya 10 years, nitaendea bank overdraft ya 1 year. Sababu nitaipata haraka. I'm taking the risk. I know very well. I'm optimistic because of the good business that I'm going to do. I'll be able to repay this bank overdraft as soon as possible, and I move forward. That's how. So who uses the short-term funds to finance better parts of the firm's assets? Full stop. Then you say short-term funds would finance. Short-term funds would finance seasonal working capital, seasonal current assets. Can call them current assets and working capital. Some current assets may growth working capital. So you can call it working capital, you can call it current assets, no problem. So short-term funds will finance the seasonal current assets and working capital, and part of permanent working capital. We'll start continue by saying extremely aggressive farm may even finance up to a portion of non-current assets, using short-term funds up to a portion of non-current assets using short-term funds, hence long-term funds only financing the remaining part of fixed assets. An extremely aggressive firm may even finance up to a certain percentage. Yeah, may even finance up to a portion of long-term funds. Up to a portion of non-current assets using long-term funds. Hence, the remaining fixed assets. What can you explain your point? Tumesema kidogo tu alafu nitapiga picha. Extremely aggressive firm, tuanzie hapo, ndio. Extremely aggressive firm may even finance up to a portion of non-current assets using short-term funds. Ndio. Hence, long-term financing only financing long-term funds only financing the remaining portion of fixed assets. Sasa, yeah, kuna vile tumeichora ka schedule fulani hapo kwa notes zetu pako hivi. So hapa chini tuko na fixed assets for the non-current assets. Hapa tuko na permanent current assets. Na hapa tuko na fluctuating current assets. So every company will have the three sets of assets. Iko na fixed assets, iko na permanent current assets that we explain, na iko na zile fluctuating. The difference comes in on how we finance them. Now, an aggressive firm will always go in for short-term funds because we don't fear risk, you are very much aggressive, right? So when you're using the aggressive policy, the short-term funds will finance the fluctuating current assets and a portion of permanent current assets. But in a firm ambayo iko extremely aggressive, inaweza ikakuja ika-finance mpaka part ya. That's our last point. So here we shall have the short-term funds. So the long-term funds will only finance the remaining portion. That's how. But an averagely aggressive firm in a finance mpaka hapa, enough long-term funds to finance the remaining parts. That's how. So this one is for aggressive. So because nimeanza kuichora, hiyo ni aggressive policy. Matching in a match. So this policy, that's the second one they mentioned, like it's gonna aggressive, matching na conservative. So the matching policy, short-term funds, short-term assets. The short-term assets need to be. So in matching, the short-term funds will finance up to the seasonal peke yake. Alafu long-term funds will finance the long-term assets. Sasa, then tukienda kwa the last one ambayo ni conservative. Tukienda kwa conservative, which is the last one. So conservative, we fear risk. So we rather go in for the long-term funds because there's no risk of being told answer immediately. You know, a conservative person, somebody who fears risk, will go in for a loan of 10 years. Knowing very well, at least niko na 10 years za kujipanga. Sindio? So you shall use the long-term funds, finance the long-term assets. Ikuje pay finance mpaka part of, so itakuja mpaka somewhere there. So there you have the long-term financing. Then the remaining part, hapo kajuu peke yako ndo katafinansiwa na what? The short-term funds. So long-term funds. It's simply the opposite of what? Aggressive. So that one is in the notes. So can we have number 2? Matching stroke hedging. Matching stroke hedging. Stroke moderate policy. We say the assets are matched. The assets are matched with their level of financing. The assets are matched with their level of financing. i.e. long-term funds would finance long-term assets. Long-term funds would finance long-term assets, when short-term funds would finance short-term assets. And short-term funds assets you can put into brackets, seasonal current assets. Seasonal current assets. Then finally, number 3, conservative policy. Conservative policy. So for conservative, we say long-term funds are used To finance most assets, long-term funds are used to finance most assets due to their low risk. Hence, the long-term funds would finance, would finance the long-term assets. Long-term funds would finance the long-term assets. The long-term assets ni fixed assets na permanent current assets. And a portion of fluctuating current assets. When short-term funds will finance the remaining part of fluctuating current assets. When short-term funds will finance the remaining part of fluctuating current assets. So long-term funds finance the long-term assets na zidipa mpaka zifike kwa the seasonal or the fluctuating current assets. Then the short-term funds will finance the remaining part. So maybe we can just put a dash hapo chini useme both profitability, both still under the conservative, both profitability and liquidity risk are low. Both profitability and liquidity risk are low. Twende kwa past paper. Let's check when it was tested. Let's do 2020. FM. So November 2020, question 2B. November 2020, question 2B. There is a plus. Page 34, here there. Now, so you're told that Nderu Suppliers Limited is reviewing its working capital commitments for enhanced efficiency. Page 34. The following information relating to the period ended at 1st March 2020 is provided. Turnover for the year 15 million. Costs as a percentage of sales. Pata swali kama hilo, cost as a percentage of sales, you start looking for the cost. So imesema direct materials is 30% of sales. Sales kilo turnover. So you can get how much direct materials were used. Direct labor 25%, ukiendelea hivyo. Additional information. On average, account receivables take 2.5 months before payment. Cha muhimu ni kujiuliza, account receivables or debtors. Debtors come from sales or purchases? Debtors come from sales. So here statement inamaanisha debtors will represent 2.5 months worth of sales. Kama mnaweza pata sales za 2.5 months, how watakuwa debtors? Sasa, because customers take 2.5 months before they pay us. Sasa, so because debtors come from sales, if we can get sales, so the sales that we have of 15 million is for 12 months, the annual sales for the year. So 15 million is for 12 months. Can we get sales for 2.5 months? That one will represent our debtors. Sasa, raw materials are in inventory for 3 months. Tunaweza pata raw materials at 3 months. Raw materials za mwaka mzima ni 30% of 15 million. We can get raw materials for 3 months. That will represent the stock of raw materials. As we progress. The work in progress represents 2 months worth of half-produced goods. So kama tunaweza pata the goods produced for 2 months, a half of them is stock of work in progress. So let's see. Let's start answering this question. So as they want us to get what? Assess the working capital requirements for the company. Of course, finished goods represent 1 month production. So production for 1 month will be the finished goods. Credit is taken as follows. Credit liabilities. Yearly liabilities. Current direct materials, usually purchases. Any purchases of raw materials. So it will take 2 months before to leave the suppliers. Direct labor will take 1 week before to leave the labor. It will take 1 month before to leave the variable overheads. We also take 1 month before you pay for fixed overheads and half a month before you pay for selling and distribution. Work in progress and finished goods are valued at material, labor, and variable expenses cost. No problem. Labor force is paid for 50 working weeks a year. Assess the working capital requirements for the company. Where do you start from? Unajichota, unasema working capital equals to current assets minus current liabilities. That's very important. Working capital is the current assets minus current liabilities. Then let's prepare the cost statement. We can have it in thousands of shillings. We have our sales. Sales in ngapi? So 15,000 in thousands of shillings, right? So less the expenses. We have direct materials. What percent of sales? So 30% of 15,000. 4,000. So 4,500. 4,500. We have direct labor. What percent? So 25% of 15,000 is coming. 37. 37.50. kuna variable overheads. 10%, 10% I know. That is 1,500. Fixed overheads. Fixed overheads is 15%. 15% of 15K. Giving us 2250. Then of course we have selling and distribution, which is 5% of 15,000. Giving us 750. So get the total expenses. From 750. Subtracted from 15,000, we remain with how much? 2250. So tushapeana formula ya working capital pale juu. Now we need to get those variables. We need to get those variables. So let's start with the current assets. Let's start with the current assets. We start with current assets. And the current assets, I can see we start with note number 1. On average, account receivables take 2.5 months before payment. Account receivables come from the sales. That's what we agreed. So current asset ya kwanza, your receivables. Kama tunaweza pata sales the 2.5 months, it represent receivables. So sales the 12 months ni ngapi? So can I say 15,000 divided by 12 times 2.5? Let us use if 15,000 equals to how many months? 12 months. How much will be for 2.5 months? How much? That's 125. So that 125 your data sweat. That is our data. Another current asset, stock of raw materials. This is a manufacturing firm. Manufacturing firm has 3 types of stock: raw materials, work in progress, and finished goods. So we need the stock of raw materials. Stock of raw materials. We hold raw materials for how long? For 3 months. Do you have raw materials for the whole year? Of how much? 4,500. Divide by 12, that is how many months? That is 3 months. So how much is the stock of raw materials? $11.25. We also need the stock of work in progress. Stock of wheat. Napo kwa stock of work in progress, note number 3 imetuguide. Note number 3 imetuguide. Kwa note number 3 tumeambiwa that the work in progress and finished goods are valued at material, labor, and variable expenses. So hapa tutakuwa na materials, labor, alafu tuko na variable overheads. So work in progress is a component of three items: materials, labor, and variable overheads. Na pale juu tumeambiwa work in progress represents 2 months worth of half processed goods. Ndio. Tuanze na materials. Can we get materials for 2 months? Materials for the whole year is how much? Is it 4,500? Divide by 12 times what? Lakini wamesema out of that, work in progress is a half. 2 months worth of half processed goods. So materials the 2 months, alafu a half of it will represent what? The work in progress. So how much is that? 375. So hiyo usipeleke mbele ni working 375. Hi. Labor. 2 months worth of labor. Labor for the whole year. 3750 divided by what? 12 times 2 months. But work in progress is represented by what? A half. 2 months worth of half processed. So that labor becomes gapi? 312.5. Then variable overheads. Can you get variable overheads for 2 months? 1,500 divided by what? We divide by 12 times 2 months, but we only need what? A half. Giving us 125. So add hizo tatu kuleta huku mbele. As the stock of work in progress. 9? 812. So 812.5. So that is our stock of work in progress. We have another current asset in form of the stock of finished goods. The manufacturing firm has 3 types of stock. Ndio. Current assets tunajua ni debtors, stock, cash. Kama tuko na prepayments tutaambiwa. In our case, tumepewa accruals, the liabilities here. We are looking at the assets, the current assets, receivables, cash, and inventory. Manufacturing firm has 3 types of inventory: raw materials, work in progress, and finished goods. So until unaweka laini hivyo. Then we also need the stock of finished goods. Stock of finished goods. Note number 3 is again guiding us. Na ikasema, the work in progress and finished goods are valued at material, labor, and variable expenses. So hata kwa finished goods, tunataka materials, tunataka labor, na tunataka variable overheads. Materials, labor, and variable overheads. Pale juu amesema finished goods represents 1 month's production. Ndio. So ukianza na materials, unatafuta materials za 1 month. 4,500 divided by what? Times what? We multiply by 1. Giving us 375. Ndio. Si hapa ni sawa na hii. Because a half of 2 is 1. So this will come back the same thing, but one thing should lazima uonyeshane. Labor nayo 3750 divided by 12 times what? Times 1, ambayo ni 312 times 12.5 still. The variable overhead, what is for the whole year? 1500 divided by 12 times what? Which is 120? 125. So the stock of finished goods is 12.5. Another current asset that can be there can only be what? Cash. Na cash inanga wapi? Hiyo unakwanga umepewa. In our case, hatujapewa, but because we are in class, we are learning, ndio sababu nimeiweka. So this gives us our total current assets. So what is the total current assets? And hizi zote? Giving us 58, 75.0, 58.75. Let me not fall in love with points. Then if they're not there. So after the current assets, we need what? Current liabilities. And from the equation, current liabilities, I can see them in note number 2. So current liability ya kwanza, and we have the direct materials. Direct materials, based on note number 2. How long does it take for us to pay the suppliers? 2 months. Can we get the materials for 2 months? For 500 divided by what? Divided by 12 times what? Times the 2 months. Giving us 750. That is for direct materials. Next, we have direct labor. How long do it take for us to pay our laborers? So can we get the labor for 1 week? For the whole year, I think that's 750. That's 750 divided by 12 times what? We divide by 12 or by 50. Nikamwona 50 penye iko. Matuachie Mungu. The direct labor we are paying after 1 week. So we divide by the number of weeks in a year. Na wamesema weeks ni ngapi kwa mwaka? 50. Sawa. Kama the period ni in months, we divide by 12 because we need the number of months in a year. Kama ingekuwa in days, would have divided by the number of days. 365, 360, mostly 365, unless otherwise stated. So you're guided by what is the duration that we take. If it is in days, you divide by the number of days in a year. If it is in weeks, you divide by the number of weeks in a year. If it is in months, you divide by the number of months in a year. Sawa. So si ati kilo agano utafanya divide by 12. Unagaidiwa na umepewa weeks, months or days. Sawa. So how much is this? 7.5. Variable overhead Tumepewa 1 month, sio? Can you get variable overheads for 1 month? 1500 divided by what? 12 times 1. How much? 125. Then we have fixed overheads. Here tumepewa 1 month. Kwa mwaka mzima is it 2250? Divided by 12 times 1. How much? 187.5. Selling and distribution, that is half a month. 750 divided by what? 12 times 0.5. Giving us
that 1.25.
1.25. So get total current liabilities. Then of course, your working capital, if this one you can call it A, and the liabilities equal them B, working capital becomes A minus what? A minus B. There is November 2019, question 4B, but we can use, there's an equivalent question of the same nature to the Tumia corporate finance. I think you have corporate finance, right? Tumia corporate finance here, zinafanana. For corporate finance, for question 3D of December 2021. December 2021, question 3D, corporate finance. December 2021, question 3D. Only has 4 marks, the average daily permanent working capital and seasonal working capital. corporate finance in December 21. X Limited. Get them. Make it up. Richard. Let me shoot the screen. Now we're there. It's limited, right? Now, it's limited total working capital requirements over the period of 5 days is as shown below. On a day of the week, Monday mpaka Friday, total working capital requirement in shillings. Then you're given some first 2 months to get the average daily permanent working capital, and you have the average daily seasonal working capital. Now, if you can remember, tumesema kuwa the permanent is the lowest we could go. Page 17, corporate finance. Screenshot ijatika. Aya, sawa. Imepatikana sasa? Right. Now, we say that there is the minimum level of working capital that the firm must always maintain at all times. So that minimum level will be our permanent working capital. Anything above that will now fluctuate, and that will be the seasonal working capital. When you look at the working capital from Monday to Friday, what was the lowest we could go? Are we saying 80? So by all means, kila siku lazima kampuni ilikuwa na 80,000. Ndio. So that minimum that we could go, that becomes our permanent working capital. Anything above 80 will now be the seasonal. So simply, if we copy na paste, we have the day, we have total working capital, which is grouped into permanent working capital, and the balance becomes what? Seasonal. So tuko na Monday, because they're in shillings. Tuko na Monday, 100,000. Tuko na Tuesday, 80,000. Tuko na Wednesday, 120. Tuko na Thursday, Thursday is 110. And we have Friday, where we have 130. Permanent inakuwa. So on Monday you have permanent of 80. How much is seasonal? Missing 20. Right? On Tuesday you have permanent of 80. How much is seasonal? Nothing. Still. The lowest we could go. Now the lowest is permanent. Permanent is fixed. So the lowest we could go at any given point, then we maintain that as our permanent working capital. So hapo ndo penye tuliweza kufika the minimum for us to continue satisfying our normal demand. Right? Great. So on Wednesday, what is the permanent? 80. So how much is seasonal? 40. On Thursday, permanent ni ngapi? Nabaki na ngapi for seasonal? Finally, hapa tuko na 80, baki na ngapi?
50.
50. They want us to get the average. The average lazima tupate total. Total. So total is 80 times 5. Is it 400? Now here total 6 plus 8. Is it 14? 140, right? 120. 6 plus 8. 140,000. So meaning total ni fine. 540 ndio. Yes, ni ile sabu ya haraka haraka. Yenyetia watu wa busy. So can we have the average? Wanataka average of the permanent and average of the seasonal. So average hapa inakuwa 400,000 divided by what? Is it 5 days in a week? So it takes us back to ngapi? 80,000. Now we can 140,000 divided by how many days in a week? 5, giving us
28,000.
how much?
28,000.
88.
28.
28.
Yes.
28,000. So that is our 4 marks, 2 marks, 2 marks. Let's check the one for FM. Let's check the one for FM. It was more involving. FM was 2019. November 2019, right? Yeah, November 2019, question 2B. At page 39, before you ask, 39 page. That is for FM. Get that? So let's go through each one. I mean, it makes sense. Maua Horticultural Limited runs a flower export business. The company has two sources of funds at different interest rates. The finance cost for short-term funds is 20%, while the cost of long-term funds is 25%. These costs are expected to remain constant in the next 2 years. The following are the projected monthly working capital requirements of the company. For the year ending 31st December 2020. So tuko na January mpaka December, working capital requirements in thousands of shillings ziko hapo. For 6 months, the average monthly permanent and seasonal working capital requirements for the company. How much is the permanent? Permanent is, I think that 5,000. The lowest we could go still. So permanent at 5,000, you balance yote inakuwa seasonal. You're able to arrange from January to December. Alafu unapata total, una divide by 12, una divide by 12 and you get your 6 marks. Imagine. Then let me ask this. Angalia number 2. Angalia number 2. Nataka tukaidiana hapa alafu uchangamke. The total cost of working capital finance for the company under aggressive financing policy. Under aggressive, do we use short-term funds or long-term funds? Under aggressive, we use short-term funds. Yeah. We have the cost of short-term funds by 20%. Yeah. So in simple terms, the total cost of working capital, the short-term funds will finance everything. Because you're aggressive. Remember the extremely aggressive farm. It will finance all the working capital in the back of permanent. So the short-term funds, when you are using aggressive, tutamwambia tu kuwa total cost equals to, is it 20%? So 20% of the total, like in our case, our total is 500 and so 20% of the total working capital. Sawa. But usifanye hiyo kwa swali ni tofauti. Utaanza kurevise, unaweza kushangaza 20% alitoa. Huko Wafula nayo. If you are using conservative, do you use long term or short term? Conservative use the long term funds. But the cost will be 1%. I think 25%. So again, 25% of the total. What if you are using matching? Like in our case, for matching. For matching, what will be the cost of short-term funds? The short-term funds ni seasonal ama permanent? Seasonal or permanent?
Seasonal.
Adverts. Naweka silent button. Weka silent, simu inakuwa na silent. Hiyo ndio nimefika concentrate. So the seasonal ni short term, ndio. So cost yake itakuwa 20%. Seasonal yetu ni ngapi? You use the total, ambayo ni ngapi? In our case it's 140,000, ndio. So you get that cost, and after the permanent working capital, 25% of what? Of 400. Right? So you have this one, you have this one. So mbili zinakuwa the total. So are you able to document that? Document lots of sharing. Advice, we can only advise. We advise based on the lowest cost or the highest cost. The lowest cost. So the aggressive one is the cheapest, right? So advice, swali ilipomeuliza nini advice on? So aggressive policy should be adopted, right? For management of receivables management. Receivables management. Then you say investment in receivables. Investment in receivables is affected by the annual credit sales. The annual credit sales and receivables period. The annual credit sales and receivables period. Receivables period or the average collection period. You can put into brackets average collection period. i.e. receivables equals to, kama unaweza kumbuka hiyo concept tulikuwa tuna apply kwenye swali ya kwanza, tulichukua the annual credit sales divide by the number of months in a year. So if kama tumekuwa the period in days, we shall divide by 365. Then we multiply by what? The receivables period. If it is in what? If it is in days. If it is in months, you divide by 12. So hapa inakuwa what is that? Annual credit sales. Annual credit sales. Let's annual credit sales. The SES. You can come and choose. So if the period has been given in months, we shall divide by 12. Ile swali tumefanya tulikuwa tumetoa in months. Ndio. Customers take 2.5 months. Receivables represent 2.5 months of. Ndio. So we can divide by 12 to multiply by 2.5. So this is the formula. The credit sales over the number of days in a year times the period in days. If the period is in weeks, we shall divide by the number of weeks. 50, 54, 52, examiner will give you. That's how. Yeah. So next point you say this. The management can influence the level of credit sales. The management can influence the level of credit sales, comma, receivables period, and consequently, the average receivables, through a change in the firm's credit policy. Through a change in the firm's credit policy. So management wanaweza influence credit sales zetu zitakuwa ngapi? Wanaweza influence how many days should our customers take to pay us, and when they change this, what is the consequence? Data wetu watakuwa affected. So they can influence the annual credits, the level of credit sales, the receivables period, and consequently it will affect the receivables through a change in the firm's credit policy. That's going to say the term credit policy. The term credit policy is a combination of 3 items. The term credit policy is a combination of 3 items, i.e., number 1, credit standards. Credit standards. So credit standards, you say, it is the credit period stroke let's just turn on a stroke. It is the credit period given to customers. Sorry for that. It's the credit period given to customers. What are our standards? First off, then you say, when the standards are so strict, when the standards are too strict, credit sales, bad debt losses, and level of debtors will be too low. And vice versa. So if you are too strict, debtors wetu watakuwa chache because very few will qualify for those terms. Credit sales zetu pia zitakuwa kidogo because we are selling to very few, the few that qualify. Na hata bad debts pia zitakuwa kidogo. Because wale ambao wana qualify already, tumewachuja na tukaconfirm kwa hao hawatatusumbua. So, yeah. Just continue by saying this. These are simply conditions put in place that customers should meet. Conditions put in place that customers should meet to qualify for credit. That customers should meet to qualify for credit. So kama hizo conditions tutaset ziko so lenient, then of course many customers will qualify for credit, meaning our credit sales zitakuwa more. Debtors pia watakuwa wengi because tumesell to many of them, right? And even bad debts pia zitakuwa more because we brought in almost everybody. When you're so lenient, when you're so strict, it becomes the vice versa. Sales zinakuwa kidogo, debtors wanakuwa chache, bad debts zinakuwa chache. Number two, credit terms. Then you say, it is the duration given to customers. It is the duration given to customers to pay their debts. And any cash discount, if provided. So what are the terms of credit? Terms of credit za hii kampuni ni kuwa ukinunua on credit lipa within 2 weeks. Ukinunua on credit lipa within 10 days. Like in our case, ile swali tulifanya, the terms of credit zilikuwa gani? Lipa within 2.5 months. Yeah. Those are the credit terms. So e.g. credit terms, tatuone kama mlifanya hesabu mzuri. Credit terms of 2/15. net 20. Credit terms of 2 over 15 net 20. What does that mean? You take your calculator to divide by 15. The net number to add. What does it mean? Shine where you can. Karibu tunafunga tunasema good night. A nice weekend. It's very nice your weekend. Any attempt? Cheza kama hayo, shine. Hapa ni harambee, unaanza ya kwanza alafu mwingine anamalizia. You want to attempt? Two?
Yeah.
Between 15 and 20 days? You get? You pay less.
I'd like to attempt.
You? Okay, attempt.
If the customer pays within 15 days, they get a 2% of cash discount.
So if you pay within 15 days, you get a discount of 2%. And if you can't manage?
You should pay within 30
is,
minutes. Yeah.
So the terms of this nature, inamaanisha, customers who pay within 15 days will enjoy a 2% discount. If you can't manage, usipitishe 20. Lazima tuwe na limit. So even if you don't, so if you pay after 15 days, you'll not enjoy the discount, but your period should not go beyond 20 days. That's how. So let's put that one down. Means, so credit terms of 2 over 15 and 20 means a 2% discount. A 2% discount is offered to customers. Is offered to customers who pay within 15 days. A 2% discount is offered to customers who pay within 15 days. While the remaining customers should pay within 20 days. So ukipitisha 15, maximum yako ni 20 days. While the remaining customers should pay within 20 days. Finally, number 3, collection efforts. Collection efforts. Then you say, these are procedures in place. These are procedures in place for dealing with overdue accounts. These are procedures in place for dealing with overdue accounts. Overdue accounts, you know what we mean? Tulikupa 20 days. 20 days imepita, bado hauja fulfill your obligation. So your accounts now become overdue. The customers who pay after the due dates. So how should we follow up? They include reminder letters. Reminder letters. You can send them some letters to remind them. Stroke mails. Reminder letters, stroke mails. Phone calls. Personal visitation. And as a last resort, before the last resort, you can talk about, factoring. Factoring, what is factoring? Okay. To include negative history of factors to consider. Then add the cost on or not they're supposed to pay. Transfer the cost to another party. Actually factoring, have you ever heard of debt collectors? Jina debt collectors ndio mnajua. Sasa mwanzo kutumia jina finance. Jina wewe finance wanaitwa factors. Sasa so factoring is use of debt collectors and it's the same thing, transferring your obligation to somebody else. So you transfer your debtors to another company to collect those debts on your behalf. So you can debt collectors. So by then custom has the cost of them. Conduit. Certified credit practitioners, CCP. So if you finish a CPA or a CIPA, is it a hot cake? Hizi mambo za tanda. It's a risky thing, lakini the higher the risk, the higher the ndio watu wanasema kwani sitakufa. Kifo ni siku moja. So in simple terms, sorry for so we can put into brackets for our own sake, lakini kindly kwa exam usiandike debt collectors. Sisi tunaandika tu hapa ili we understand kwa haraka. Use of debt collectors. And as a last resort, kama option, kama legal suit. And as a last resort, legal suit. Wapeleke tu kotini kama kuna any other option, because ukipeleka customer wako kotini, you forget about him or her. Hata irudi ndio. Hiyo ni ile time unasema niwe liwalo after all. Wacha nirudishe pesa zangu na kuachana naye. So that one becomes the last option. Ile upata customer ni ngumu, jaribu kuwa maintain. Sawa. So as we conclude, just keep one line and that step. In case of kazi yao ni she's asking about the factors. And then but the factors are not individuals. Factors are companies that exist to help other companies recover their debts. So you transfer all your debtors to that other company and they manage them. Sasa wewe ni kazi yako ni kufanya nini? Ngoja pesa zako. Bila watazipata si shida yako. Even if it means auction. As long as you have a deal, you have an agreement that you'll get your money. And immediately you sign that contract, these people will advance you, like they'll tell you, give us a job, we get you 80% of your debtors immediately. So it becomes upon us to recover the 100%, get back our 80% and give you the balance of 20%. So they have to be harsh. That's how they can even auction. That's why we don't encourage. Lakini kama kameumana, so they can go out. After all, by the way, customers see, wow, do they care? They don't. They really care about recovering their money. So already washapea na 80%. So they cannot accept to go at a loss. That's how. Because immediately when I sign contract, the contract says, I'll give you like 75%, depending on how you agree. So I give you 75% of what you're expecting from your customers, then I take full responsibility. Your customers will no longer pay to you. Your customers now become mine. They'll be paying to me. Then I give you back your 25%, I charge my fee, and I recover my 75%. That's how. Yeah. So can you just make a statement before you go away? So keeping one line. Anyway, so Friday inakwanga hivi. Lakini mwende mnaenda box leo. I wish kesho tungekuwa na class ningejionea. Keep well, and then you say this. We prepare a cost benefit analysis. We prepare a cost benefit analysis to evaluate the effect of a change. Evaluate the effect of a change in the firm's credit policy. The effect of a change in the firm's credit policy. Most of them is saying increase in current assets. Increase in current assets leads to an increase in opportunity costs. Increase in current assets leads to an increase in opportunity costs. When increase in current liabilities, leads to a decrease in opportunity costs and vice versa. And vice versa.